May was one of those months where the market basically said, everything is great. And then interest rates quietly walked into the room and said, not so fast. Stocks hit new highs. The S&P 500 crossed 7,500. IPOs started getting attention again. Inflation was still hanging around. Long-term interest rates jumped. And guess what? We got a new Fed chair. So yes, May was a very, very strong month, but it was not exactly boring. Today, we're doing a market update for what happened in May and what's possibly to come in June. This is not a prediction, not a panic button, not one of those market updates where someone uses 12 acronyms and somehow says absolutely nothing. We're going to cover three main things: what happened, why it matters, and what investors should actually pay attention to. Because market information is useful only if it leads to better decisions. Let's start with the obvious headline. Stocks had a very, very strong May. According to the May market update, the S&P 500 gained 5.1%, the NASDAQ gained 8.4%, and the Dow gained 2.8%. All three major US indices finished the month at new all-time highs. The S&P 500 also moved across 7,500 for the first time, which is pretty darn impressive. And also the kind of headline that makes people immediately ask, should I be excited or nervous? Here's the important point you need to know. All-time highs are not automatically a warning sign. Markets have historically moved higher over long periods of time. So if markets are working the way long-term investors hope they work, they should reach new highs occasionally. The uncomfortable part is psychological. When markets are down, people are nervous because guess what? They're down. When markets are up, people are nervous because, yep, they're up. Apparently, investors are just committed to being really, really uncomfortable. But seriously, the level of the index matters less than what's underneath it. Are earnings growing? Are valuations stretched? Is rally broadening? Is the portfolio still aligned with your plan? That's where the real conversation is. While the stock market was celebrating, the bond market was having a slightly different experience. Long-term interest rates rose during the month. The 30-year Treasury yield reached 5.18%, which was its highest level in nearly 2 decades before settling back to 5%. The 10-year Treasury yield also rose to 4.4%. That matters because higher interest rates affect almost everything. They affect mortgage rates, business borrowing, real estate valuations, bond prices, stock valuations, private investment assumptions, and whether a business owner decides to expand or wait. For business owners, this is not just a Wall Street issue. Higher rates can hit the real economy. They affect the cost of financing equipment. Think about it. They affect the lines of credit, they affect the growth decisions, they affect the math behind deals, which is why the phrase higher for longer is not exactly the kind of thing you put on a motivational poster. Nobody is hanging that in the office break room next to teamwork with a bunch of eagles. But there is also a second side to this. Higher yields can mean bonds offer more income than they did for much of the last decade. So the bond conversation is not simply rates are bad, it is more nuanced. Higher rates can create pressure, but higher yields can also improve future income potential in diversified portfolios. The reason rates were under pressure comes back to inflation. The May update noted that inflation reports came in above expectations, largely due to energy prices. April headline CPI was 3.8%, core CPI was 2.8%. Oil prices did come down during the month, with Brent crude around $92 and WTI around 88. But energy prices were still part of the inflation conversation. This is where everyday life and investment markets connect. Inflation is not just a number economists argue about. It shows up where? In gas prices, food, travel, business expenses, payroll, insurance, construction costs. For families planning summer trips, it shows up the moment you realize the gas pump has apparently developed an ambitious retirement plan. From an investment standpoint, inflation matters because it changes interest rate expectations. Think about it. If inflation stays elevated, the Fed may have less room to cut rates. If inflation cools, the conversation changes. And that uncertainty is why markets can swing sharply around inflation data. The other major headline in May was the leadership change at the Federal Reserve. Kevin Warsh was sworn in as the new Fed chair, succeeding Jerome Powell. Anytime there's a new Fed chair, markets naturally start asking, what changes are coming? And that is a fair question. The Fed influences interest rates influence borrowing influences businesses, and businesses influence earnings. So yes, Fed policy matters, but it is not the only thing that matters. The report makes an important point. Over long periods of time, markets and the economy have grown across many different Fed chairs. Why? Because long-term returns are ultimately driven by things like earnings growth, productivity, innovation, demographics, and the ability of businesses to create value. In other words, the Fed is important, but it is not the entire movie. Although based on the financial news coverage, you would think every Fed meeting is the season finale of America. Another interesting piece from May was renewed excitement around IPOs. With the market at new highs, there's been more attention around potential IPOs from companies like SpaceX, Anthropic, OpenAI, and others. And that naturally gets people interested because IPOs have this emotional pull. It feels like access. It feels early. It feels exclusive. And exclusive is a very powerful word in finance. There's also a word that has separated many people from perfectly good money. The important point is that many companies have stayed private longer over the past couple of decades. So by the time some companies go public, a lot of growth may have already happened in private markets. Now, that doesn't mean IPOs are bad. It means investors should stay thoughtful. The question is not, can I get access? The real question is, does this fit my plan? So, what do you do with all of this? Stocks at new highs, rates still elevated, inflation still a factor, new Fed leadership, IPO excitement coming back. The answer is not to guess the next headline. The answer is to make sure your plan can handle multiple outcomes. That means asking better questions. Is my portfolio still balanced? Has the rally made me more concentrated than I realized? Do I have enough liquidity? Am I taking risk intentionally or just because markets have been strong? Do bonds still play the role I expect them to play? Does my plan depend on rates falling? For business owners, does higher financing costs change my growth plans? For retirees or pre-retirees, does my income strategy still work in different rate environments? These are all planning questions, and that is where investors should spend their energy. New highs are information. They are not instructions. The market being up does not mean you should chase. The market being expensive does not mean you should hide. Rates being high does not mean you should abandon the plan. It means you should review the plan. The bottom line is this: May was a strong month. Stocks reached new highs. Interest rates reminded everyone they still matter. Inflation, not fully gone. The Fed has new leadership and IPO excitement is starting to pick up again. But none of that changes the core discipline of investing. Stay diversified, stay balanced, stay aligned with your goals, and make decisions based on your plan, not the emotional temperature of the month. If you want more conversations around markets, business owner planning, tax strategy, investments, and building wealth with intention, make sure to subscribe to the channel, and we'll see you soon.